What if the most dangerous target in the Middle East is an unexpected one? Forget the oil fields. Think about the water pipes. There is a chain reaction already in motion. It starts in the Persian Gulf, it runs straight through Tokyo, and the final link in that chain sits directly in your retirement account. Everyone is watching the Strait of Hormuz. We track the tankers, the shipments, and the energy supply disruptions. And certainly, oil blowing past $110 a barrel matters. But look at this map showing water sources in the Middle East. 99% of Qatar's drinking water comes from desalination plants. These countries rely entirely on massive industrial treatment facilities to maintain their domestic water supply. That creates an immense asymmetrical vulnerability. Adversaries like Iran do not need a nuclear weapon to threaten the region. They can simply hit the power grids that feed those plants, or attack the pipelines running the facilities. Take out the water, and you crash the entire civilization. The collapse of the oil economy is simply a secondary effect. Most analysts stop their modeling right here. They calculate $15 a gallon gasoline in the United States and call it a day. But to find the actual economic time bomb in this crisis, we have to look across the globe to Asia. An energy shock in the Gulf immediately becomes a lethal financial crisis for any nation that relies entirely on imported fuel. That brings us to Japan. America's closest ally in Asia is a country that produces zero domestic oil. And right now, they hold $1.2 trillion of U.S. Treasury bonds. As global oil prices jump, traders run to the safety of the U.S. dollar. When the dollar spikes, every other currency drops, especially the Japanese yen. This chart compares global oil prices to localized costs. While the world sees Brent crude at $112, the collapsed yen means Japan effectively pays $140. If this trend line falls toward 160 yen to the dollar, ordinary citizens face a crushing cost of living crisis. With a broken currency and an exploding energy bill, Japan is backed into a corner by a crisis it did not start and cannot control. To defend a falling currency, a central bank would normally raise interest rates. But Japan cannot do that. Their national debt is so massive that a rate hike right now would force their domestic economy to implode. This pie chart shows the projected Japanese government budget. By 2029, debt servicing costs alone are expected to hit 41 trillion yen. Just the interest payments will eat 30% of their entire budget. So the Bank of Japan faces an impossible math problem. They cannot raise rates, they cannot let the yen collapse, and they cannot sit still while imported oil bankrupts them. There is exactly one move left on the board. Japan has to begin liquidating its massive stockpile of U.S. Treasury bonds. Their only mechanism for survival is to take the $1.2 trillion of American debt they hold, the largest single foreign holding on the planet, and sell it back onto the open market. This graphic illustrates the core mechanic of the Treasury market. Bond prices and yields move in opposite directions. When Japan sells a massive volume of bonds, their price drops, forcing U.S. yields to spike upward. Yield is the annual return realized on a bond. We are already seeing the pressure. The 10-year yield is creeping toward the critical 4.6% threshold. The administration knows exactly what that level means. The last time yields crept above 4.6, it caused a 15 to 20% stock market collapse and forced President Trump to reverse course on his trade war. When those yields shoot up, the cost of borrowing money across the United States explodes. That translates instantly into higher mortgage rates, higher car loan payments, and surging credit card interest. A recession does not arrive with a press release. It begins exactly like this, when the cost of capital suddenly chokes the American consumer. JP Morgan has already run the numbers. If U.S. crude hits $120 a barrel, inflation jumps, the stock market drops 15%, and GDP contracts by nearly 3%. U.S. leadership knows the oil price is the choke point for this entire chain reaction. That is why the Treasury Department has been quietly lifting sanctions on Russian and Iranian oil. They need the supply to keep global prices suppressed. And this Treasury crisis is colliding with other major inflationary pressures, including the Pentagon asking for an additional $200 billion for conflicts that nobody is officially calling a war. Step 1 for your own defense is to log into your 401k or IRA today. Check your asset allocation and audit your account for overexposure to long-term bonds and highly leveraged equities.
While mainstream finance ignores this specific threat, one asset class is already moving in response to the massive impending unwind of the yen carry trade. The yen carry trade is a strategy where investors borrow yen at low interest rates to buy higher-yielding assets elsewhere. Preserving your wealth relies on seeing the full global board. The ripples in these markets always reach retail investors last. You have to understand the threat underneath the headline and reposition your portfolio before the institutions make their inevitable move.